It drives me absolutely crazy watching people throw money at the stock market like they're feeding coins into a slot machine, while completely ignoring the fact that they have credit card debt charging them 22% interest. It's like trying to fill a bucket that has massive holes in the bottom and wondering why you're not making any progress. Instead of throwing dollars at whatever sounds exciting, there is an optimal, mathematically proven sequence for investing your money. We're going to map out exactly 7 steps that remove the guesswork and replace it with an order of operations designed to maximize your returns. Before we start, you need 3 things in front of you: a list of your current debts with their interest rates, your employer benefits handbook, and the details of your health insurance plan. Most people ignore this sequence because doing the boring foundational work isn't as thrilling as trying to time the market or picking individual stocks. But skipping these steps to chase exciting investments guarantees that your returns will be eaten by interest, taxes, and fees. Following this exact order is how you actually build a financial house that lasts. Step 1 is establishing an emergency fund. Start by saving your first $1,000 as quickly as possible to cover minor unexpected expenses. Once you hit that, build up to 1 full month of living expenses, and then keep going until you reach a 3-month safety net. This chart highlights recent research from Vanguard showing the exact moment a psychological safety net kicks in. People with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than those without any buffer. That is the largest positive boost linked to any single financial factor Vanguard measured. Step 2 is to pause any current investing and eliminate all high-interest debt. For this system, we define high-interest debt as anything charging you more than about 8% annually. Credit card debt averages over 22% interest. Mathematically, paying off a balance with a guaranteed high interest rate provides a guaranteed return equal to that exact rate. Earning a guaranteed 22% return is better than Warren Buffett's long-term average. To pay this off efficiently, list all your debts and make the minimum payments on everything. Then throw every extra dollar at the debt with the highest interest rate. This is called the debt avalanche method, and mathematically speaking, it saves you the maximum amount of money. Carrying credit card debt while investing is like trying to run a marathon with a backpack full of rocks. Stopping this hemorrhage of interest is a mathematical requirement before you attempt to accumulate wealth anywhere else. Step 3 introduces the one major mathematical exception to paying off your debt first. If your employer offers matching contributions to your retirement plan, you should contribute enough to get the full match immediately. An employer match is essentially a guaranteed 100% return on your investment up to the match limit. Even if you're carrying 22% credit card debt, capturing a 100% immediate return makes mathematical sense. It is free money lying on the table. You do need to check your company's vesting schedule. This determines how long you have to stay at the job before those matching funds actually belong to you. If you leave too early, you forfeit the money. Step 4 is to open and maximize an individual retirement account, or IRA. For 2025, that limit is $7,000, or $8,000 if you're 50 or older. You want to fund your IRA before putting additional money into your 401k, because IRAs give you complete control over your investments. Corporate plans often restrict you to a limited menu of mutual funds that charge 1 to 2% in management fees. With an IRA, you can buy low-cost index funds and keep your money instead of slowly feeding it to fund managers. You'll have to choose between traditional and Roth accounts based on when you want to pay taxes. If you are in a lower tax bracket now, but expect to be in a higher one later, route your money to a Roth account to lock in today's low rate. If you're a high earner right now, route your money to a traditional account to deduct the contribution from your current taxable income. Securing your corporate match and funneling money into a low-fee IRA creates a serious wealth multiplier. You lock in guaranteed corporate money while establishing total control over what you pay in investment fees. Step 5 is the Health Savings Account, or HSA. To utilize this account, you must have a high-deductible health plan. The HSA offers a triple tax advantage. You get a tax deduction for the money you put in, the investments grow tax-free, and any withdrawals you make for qualified medical expenses are completely tax-free. No other legal investment vehicle gives you tax benefits on the way in, during growth, and on the way out. The optimal strategy here is to pay for your current medical expenses out of pocket if you can afford it, and leave your HSA money invested in the market. Since there is no time limit on reimbursements, you can keep your receipts and withdraw that money tax-free 20 years from now after it is compounded. Step 6 is to go back to your employer's 401k. and start contributing beyond the match, pushing all the way up to the federal limit of $23,500. When you max out your IRA, your HSA, and your 401k together, you are legally shielding over $35,000 annually from taxation. That is serious money compounding every single year without the IRS taking a cut. The average American saves about 6% of their income. If you follow this sequence and maximize these 3 accounts, you place yourself in the top 5% of savers, building wealth that the government cannot easily tax. Step 7 is funding taxable investment accounts with any remaining money. These accounts act as the Wild West of investing. There are no contribution limits and absolutely no restrictions on when you can withdraw your cash. This graph charts a 30-year projection of investing $10,000 annually at a 7% return. The top line represents a tax-advantaged account, while the bottom line tracks a taxable account. In a taxable account, every dividend payment gets taxed, and every capital gain triggers a bill from the IRS. The tax drag of the lower line creates a massive gap over time. The tax-advantaged account ends up at roughly $944,000, while the taxable account finishes closer to $700,000. That is nearly $250,000 lost entirely to taxes. Taxable accounts offer incredible flexibility if you need money for a house down payment or want to retire early. But because they are highly inefficient, they only make mathematical sense after all your tax-advantaged buckets are entirely full. This is your optimized financial foundation. You build your emergency fund, eliminate high-interest debt, secure the employer match, max the IRA, max the HSA, fill the rest of the 401k, and finally spill over into taxable accounts. Look at this checklist right now and find exactly where you are stuck. You might be working on step 2 with credit card debt, or maybe you're sitting at step 5 trying to set up your HSA. Once you identify your current step, log into your banking accounts today. Set up an automatic transfer to direct your money specifically to that one target, so you make progress without having to think about it. Your future self will thank you for doing this boring stuff first. Because mastering these foundational steps in this exact order is the definitive difference between gambling with your money and systematically engineering your wealth.